Right. Hello again, everybody. Hope you're enjoying your breakfast. Please don't let me interrupt you, but I'd like to kickstart the next stage of our session. So it gives me great pleasure to be able to welcome Alex Sidorenko to the stage. Alex is an experienced executive across strategic, investment and operational risks and insurance, working with multi-billion-dollar corporations in GCC and Europe. He's the author of the popular free risk management book, which has been downloaded more than 200,000 times, and I think we're up to what now? Three language translations. Yep. Well done. Alex has also been honoured with many titles and awards over the years. It includes Risk Manager of the Year from the FERMA 2021, Best International Implementation 2021 from RIMS, Risk Manager of the Year from RUS Risk in 2014, and Best Risk Implementation for RUS Risk in 2014. As I mentioned before, the RMAA and Team Archer are really, really pleased to be able to welcome Alex to the stage. Alex, over to you.
Thanks. Thanks, Sam. Just checking that my mic is on. Okay, perfect. Well, over the years, I've created this social media persona of controversial posts on LinkedIn, which I have 5 million views per year, that people forget that Risk Awareness Week, Risk Academy, my books, my articles, I have 1,000 articles and 1,000 videos, and Risk Academy YouTube channel, which is very popular. People forget that this is all a hobby that I do after work and on weekends. During the days, my last 3 jobs were a CRO of a multi-billion-dollar sovereign fund, a CRO of a $10 billion global fertilizer company, and my last role was head of risk, of operational risk, investment risk, and insurance of a group of companies with combined revenues of $25 billion. Keep that in mind. If this was an Australian company, this would have been the 5th largest company in all of Australia. And I was the head of risk and insurance for that. And the reason FERMA, the European Risk Management Association, named me the best risk manager in Europe 2 years ago, not because of Risk Awareness Week or the other hobbies or social media posts that I do, but because what I've done for the company and the millions of dollars we save through quantitative risk analysis. So make no confusion. You can talk to me about my provocative posts, but I'm also a pretty good modeler and a risk manager that I do during the day. And in fact, my next role, which I'm about to start, is a head of risk and insurance for a large multi-billion-dollar miner in Brazil. So my 90% of the time role, my hat that I wear is a senior executive in risk. And so everything that I will share today are the actual models that I built with my team and we've implemented, and the millions of dollars we saved, or the presentations we did for the Ministry of Finance, or the legislations that we've changed based on that risk analysis. And I'm not saying you should be doing the same. All I'm saying, these are the stories that I've done, and this is what got me named the best risk manager in Europe, and you can kind of take away from that what you want. Everything else that I do is literally a hobby. Yes, I created the biggest risk management conference on the planet. Yes, my free risk management book is #1 in Google. If you Google free risk management book, it's the first one there. Yes, I have one of the most popular YouTube channels, and my blog has millions and millions of views every year. But my day-to-day job is being a senior risk executive. So today I wanted to talk about kind of 6 things or 5 things. First, I wanted to share some of the kind of foundational principles that I held with my team and that allowed us to save millions of dollars through risk management. And again, make no mistake, our risk analysis paid for the risk management team itself. In a single year, we saved more money than as our whole salaries, software budgets, bonuses, travel expenses for the next 10 years. For us, risk management was never a cost center. We make so much money that for the company by managing risk that I present to the board and to the audit committee saying, this year we saved this many millions, next year we're going to save this many millions. Risk management has never been a cost center for us. Then I'm going to talk a little bit about a few case studies, like 3 stories of how we apply basic risk analysis. Then I'm going to share a few stories on how we apply advanced risk analysis. And then we'll wrap up with some key takeaways and additional resources. Wherever possible, I tried and linked my stories to kind of somebody else's stories, because every year, and again, I don't know if you're familiar with it, every year, every October, I run a risk awareness week, which is literally like a week of 50 workshops online from some of the best people that I respect in the profession. And they are NASA engineers, Stanford professors, and some of the best authors on risk topics in the world. And so they share their case studies, and those case studies now sit on these online platforms called Risk Awareness Week. And all of them are still available. Most of them are free. And it's very easy to find. Risk Awareness Week, again, is like #1 in Google. And every year, 5,000 people from 120 countries participate in those events. So I'll actually attempted to link some of the stories that I shared to other workshops, other stories that, for example, ex-CRO of Lego did, or somebody in Denmark did, or a Stanford professor did for his clients or his research. And so there are QR codes on the slides, and you can just take pictures if you want. So that's the intro. Don't confuse me. Alex on social media and Alex in work are 2 different people. And I have a lot of fun on social media, but never confuse that. I'm not a Risk Academy author. No, I'm a CRO first. And now that we kind of got that confusion out of the way, the first point that I wanted to make: nothing of what I'm going to describe is in any way innovative or new. All of these books have been available for at least a decade. And this is my must-read list for any risk manager on the planet. In fact, 2 of the books, Doug Hubbard's Failure of Risk Management and Sam Savage's Flaw of Averages, actually had a 2nd edition published a couple of years ago, because these books have been around for so long. So all the theories, all the techniques, all the instruments that I'm going to share, I've learned from these books. It just was 10 years ago. So first, the principles that allowed my team to save millions. And this was my last team, because people usually ask, like, how big was my team? By the way, our overall risk team was like 60 people, because the shareholders took risk management seriously. And because we were paying for ourselves, they didn't have any trouble kind of giving us a lot of resources. But my specific team, when I moved into this holding company, $25 billion holding company, my role was narrowed to specifically operational risk, investment risk, and insurance. And so my team was me, 2 quants. One of the quants is like this math genius who I wouldn't even let out of the room. Like, he was incomprehensible to anyone in the organization, but he's probably the best mathematician I've ever seen in my life. 2 quants, 1 girl who was very passionate about psychology and risk culture, risk perception, neuroscience, and the human aspect of decision making, and 3 guys in insurance who I just hired off the market. They were like the best insurance guys in the market, which was, again, very fun, because they brought in all the best practices from the insurance industry to us. And because one of my principles, as I'll share, is challenge everything, A/B test hypothesis, we started testing all of their best practices, and it actually turned out to be completely false. Most of the best practices in the industry are completely false. So the principles that it's all about setting the context, because then I'll jump into the actual case studies that we've done, and most of them probably will not make sense, but hopefully with this context, you'll bridge the gap quicker. Again, most of the case studies you will not recognize, and in fact, like, soon I'll show you what the risk profile looks like, and it's probably not a risk profile you're familiar with. But this is the way, just keep in mind, like, I'm not saying this is what everybody should do. I'm saying this is what I did, and this is what got me called the best risk manager in Europe, and this is what paid for the whole risk management team. So the first principle, which is kind of absolutely fundamental, risk management doesn't exist in a vacuum in my world. That means we don't do risk identification for the sake of managing risk. We don't do like risk profiles for the sake of having a risk profile and mitigating the risk. We're doing risk analysis. We only start risk analysis when there is a decision at hand. Somebody wants to buy something. For example, we were buying a mine in Brazil, and they had an idea of what the price for the deal should be. And they also had an idea of how the deal structure should be written up in the legal documents. And so we did the risk analysis to see if we can adjust the price for the mine and to identify any risks that need to be explicitly stated in the contractual agreement with the seller. So risk analysis in my world is only done when there is some sort of decision at hand. For example, somebody wants to budget for maintenance for the next year. Well, that's an uncertain decision. How much do we budget for maintenance for a chemical plant? And is it last year plus 5%? Or is it actually something driven by the risk profile? And so we would calculate the risk exposure, operational risk for a chemical plant to determine how much they actually need to budget given the operational risk. So in my world, risk management happens only if there is some sort of decision at hand. It doesn't happen in a vacuum, never. So the second principle is that the reality is nobody really knows what they're doing. And so there's never kind of a best way to approach something. Just because it worked before, you don't know if it's a placebo effect or if it was just luck or it was something else, or if it was in fact a really good solution. So instead of committing to something, we always A/B test. A/B test is basically like when you prepare two versions of the same document, or you use two methodologies, and you send out both to different people without telling them that they're kind of part of the experiment. So we experimented with everything. Especially insurance buying. Like we would divide the markets, we would send them different packages, we would, all completely truthful obviously, but just presented in a different way. So A/B testing, or this hypothesis testing, is one of the most fundamental things that, that my team did, and I'll show you in the case studies what that means. And the third kind of principle is that unlike this kind of hype that we live in, how everybody's telling us that the world is a riskier place and there's new sexy risk every year. Used to be cyber, then now it's climate. Next year, I don't know what it will be. So something, I don't know, diversity or something. Like it's always something. Like there's always a flavor of the month. The reality is the math behind each of those risks is almost identical. And the math behind, like if somebody wanted to move beyond just the slogans and feel-good statements and just kind of, your keynote presentations at the conferences, if they actually wanted to quantify any of those risks, the math behind most of those risks is almost identical, and in fact it uses the techniques from like military in 1960s or oil and gas in 1970s. So risk management is actually pretty plain vanilla if you really deep dive into the underlying methodology. There's literally like 5 techniques, and I'll show you each of the 5 as we've implemented. There's literally like 5 techniques that people all over the world use to deal with uncertainty when making decisions. So this message has 2 implications. A, it is highly unlikely that you will ever need to come up with a methodology that doesn't exist. It may not exist, and that's the weirdest thing. And let me just show you this just to illustrate the point. Notice how these are the best books for risk management professionals, in my opinion, and the only 2 books that have the word risk in it is Doug Hubbard's, which says the failure of risk management, and mine, because I just didn't bother. And all the other books have no risk management in the title, and that's a very subtle hint. If you want to learn about risk management, you should never read a book that has the word risk management in the title, because most of those books are risk management 1. And it's the same with methodologies and techniques. If you really want to solve a risk, if you want to come up with a methodology, then you can't really talk to other risk professionals because they probably don't have a solution for that. But you can talk to engineers or data scientists or decision analysts, and I bet they have a solution for that exact risks. And this is one of the harsh life lessons, is that most organizations on the planet actually do really good risk management, but for some bizarre reason, it usually happens outside of the risk management department. One of the most embarrassing things I've ever seen in my life was I was at the conference done by one of the large airline engine manufacturers, and I was walking past the room where the engineers were talking about how they use Monte-Carlo to simulate different engine designs. And I'm going like, that's natural. Like, how else would you do it? That's such a given for engineers to do. They use Monte Carlo when they build bridges because it's a given. It's like the technique has been around since 1946. Like, why wouldn't you use it? And so then I walk into the next room where the risk managers are aggregating, and they're saying like, they're discussing what color the heat map should be. And I'm going like, embarrassing. So most risks on the planet have existing methodologies. It just may not be in the risk domain. And this is what we've been doing. And this is, for example, why I created Risk Awareness Week, because I've become friends with a lot of data analysts, data quality specialists, and data scientists and engineers, because they actually tend to possess the best risk management techniques. And by the way, one of the simplest, shortest, and most powerful guides on risk management techniques, actual risk management techniques, is the CIA's primer on decision making. It's a free document online. It's CIA primer on decision making. It's like, 5 pages, and it lists more good risk management techniques than any risk management book, I can bet you. And so the second last principle that we had is anything really goes. Like with the methodology, anything goes until proven otherwise. Because once it's proven, once somebody in the world proven that a particular technique doesn't really work, or adds additional error, or gives you more leads to worse decisions than better decisions, continuing to use this kind of flawed methodologies is kind of negligent. And I think it's up to us risk professionals to stand up and convince the other stakeholders in the organization that some techniques really shouldn't be using. The chair of the audit committee has been asking me for a heat map for like 5 years. I've never given him one, and never got fired. So I think those fears are unfounded. And then the final technique, which is again the word many probably are not familiar with, backtesting everything. It's like whatever risk analysis we do, we backtest it at some stage, because if we said that there is this probability of success, we have to check that as the time passed, did they actually fit? Because many of the methodologies, when we backtested them, even our methodologies didn't actually hold up true, and so we dropped them. So it's this constant way of discovering, you've quantified the risks in a particular way, but did it actually add to the decision? Did it actually improve? We don't always know. So that's the quick intro on the principles that kind of sets the context for the whole discussion. So quickly on this, this is the basic terminology that risk managers should possess to really understand and appreciate everything I'm going to talk about. This is what a risk profile looks like. Any risk on the planet is a distribution. Distribution means it's a range from nothing serious to catastrophic. And the higher the bars, which means the higher the probability of a particular scenario. So it's a range of scenarios. Nothing happens to something catastrophic happens. And this applies to absolutely any risk. Like the fire could be nothing serious to a moderate fire, the fire that was extinguished by fire extinguishers, or to a sprinkling system, or just catastrophic fire, destruction of building and life lost. So any risk is a range. And the way we represent risks is usually by this distribution function, by kind of multiplying the frequency distribution with the consequence distribution. And this this applies to any risk on the planet. And this is the language of risk management that we use in our organization. And that has kind of switching to that language may look scary or complicated at the beginning, but this comes with so much added benefit that you can use that language to actually make a lot of money for the company. So this risk profile, and by the way, here's the QR code that leads to kind of to a workshop that explains a little bit more about the concept. This risk profile has three important elements. The three terms that, again, I hope over time every risk manager will start knowing and kind of using as their go-to. Because this is what financial services have been using for, I don't know, 20 years, 30 years. Three words: expected losses, unexpected losses, and tail. Any risk profile has three components. It's basically the first, left to the first yellow line, which is the expected losses. And that basically means, given that risk exposure, the company is expected to lose X amount of dollars on average. This basically means that whatever your budget is, you should probably adjust it by this amount because it's going to happen on average any given year. And so it would be silly not to account for that in the budgeting process. The second component, which is kind of this second yellow to first yellow to the second yellow, is the unexpected losses. This is like a plausible worst case scenario. This is what the company should usually incorporate into their liquidity calculations and treasury and say, well, if something bad does happen, do we actually have sufficient capital to cover that? Do we have a sufficient liquidity money to protect the company? And if the company doesn't have sufficient money, then we either need to insure that risk or somehow hedge it. And then tail is the kind of the catastrophic scenarios where the insurance usually plays. So this is what a typical risk profile looks like, and there are kind of two approaches how to do it. The top-down, I somewhat ironically called it frequentists versus Bayesians. Again, two words that are very familiar or should be familiar to risk professionals, but this basically means there is the top-down approach where for a given risk you have historical losses, and then you can take those historical losses, historical incidents, and you can convert them into a frequency distribution and to an impact distribution. And you multiply the two using Monte-Carlo because multiplying distributions is easy, but you can't do it in your head. And you get a loss curve. So this is a risk profile, and there's a little line, but you can't see it. It's called the loss exceedance curve. Loss exceedance curve is like literally the go-to technique for any risk professional in any risk, outside of maybe some regulated risks. Although market and credit risk obviously fit in this quite easily. So the one approach is to have the losses, take the frequency, take the impact, multiply the two. The trouble with that, and I'll actually show you literally in 2 slides, an example where you don't actually have losses in a nice enough format that you can multiply the two. So you have to go bottom up. You have to build up the tree for the risk. You have to build the deep dive into the risk and build the bow tie almost of a risk, and then you can kind of come into the distribution from the bottom up. And so this is the kind of the second go-to technique. This is what a heat map looks like if you did it properly. It's called the tornado diagram, but it's basically it's a mathematically correct way to prioritize risks. And again, you can do it by expected losses, unexpected losses, or you can do something fancy, because this is, I don't understand why, but this is somehow the kind of most common question people ask me. How do you quantify reputation risk, or some other obscure, strange, and irrelevant thing? And we had the solution, we, the quantitative part of the world, had the solution for like, I don't know, 50 years. Because there's this whole theory called utility theory, which allows you to convert any risks into these metrics, utils, or utility metrics. And you can actually then compare uncomparables. And I didn't kind of pre-plan it, but I think it's a nice kind of heads up for the Archer guys. They are the only company in the risk management software that I know that actually integrated this utility theory in their risk registers. So they prioritize the risks based on utility if you ever needed to prioritize safety, reputational, and financial risks together. That being said, me as the CRO of like 3 multi-billion-dollar corporations, I have never in my life faced that problem. It's not a thing. But anyway, if it's a thing for your company, then this problem has been solved. Utility theory, read up on it. It's a great methodology for comparing, prioritizing uncomparables. Very famous in decision science. And it's an indication that we may not be familiar with that, but it doesn't mean it doesn't exist. It's part of a different world. And I think part of my kind of success in risk was that I always jumped into the other worlds to see what's happening out there. Because the decision science world and the neuroscience world and the probability theory world, they have so much we can borrow for our risk profession. And they've solved any problem you can think of. And I challenge you to think of some sort of problem in your risk methodologies and ask me at some stage, and I'll point you to the methodology where this has been solved in 1970 or 1960 or maybe in 18th century or maybe 15th century, because most of the probability things come from 15th century. So anyway, now I'm going to go into the case studies that my team has done and the results that we got. These are all sanitized but real presentations. Like this is what we showed executives. This is what we presented to the board audit committee. I'll show you some of the things that I presented to the Ministry of Finance. I'll show you some of the things I presented to the Ministry of Energy, and I'll tell a little bit of stories around that. So the first example, and this is basic stuff. Like this is as basic as it gets. In my company, not in the world. And I appreciate that this could be pretty advanced for the world, and that's one of the reasons why I was named the best risk manager in Europe, but also the RIMS in US named us the best risk implementation, kind of international implementation in the same year. So operational risk. We had 2 challenges. The shareholder gave us 2 challenges. He said, A, I want to improve my budgeting for operational risks and for maintenance for chemical plants. And B, I need to know how much capital we need to hold for worst case scenarios so the company doesn't go bankrupt if something explodes at the chemical plants. Because whatever capital we don't have to hold, we can invest it into new projects. So we had to quantify operational risk. The generic approach that anybody would do that, they would go to the chemical plant and say, give us your incident registers. Give us your incident registers where you had production stops, delays, equipment damages, and all other incidents that may affect your production output. And so we did exactly that. And what we discovered is that they had incident registers, but for some reason they had like 3 or 5 things in there. And that clearly didn't map against the production volumes that we were able to observe and the financial statements. And it's weird because the production teams, they always hide it. Like they could have like a week breakdown and then they would just produce double the following week. So they're very clever about that. And so our initial approach was, let's do what the banks do. And because our shareholders are all bankers, they said, use Basel. And we said, well, Basel is not applicable. But then we actually discovered that, yeah, it works just as well. And that's why I'm saying for every method, even this is just how weird it is. Banks are really bad at operational risk. And yet, the methodology that they regulate or proposed is still decent enough that can be used for a highly operational, highly risky chemical plant, which is super high risk. And so we were able to use almost with minor modifications the methodology. So we went there and we thought, okay, we'll take the incidence, we'll take the frequency, take the incidence, take the impact, multiply the two, we're done. That didn't work because they had no incidence, and that clearly was a lie. Many reasons for why they lie, but we had to find a workaround. So we actually looked at the Basel methodology, and what we ended up breaking down operational risk into kind of 5 buckets, which was health and safety, quality issues and returns, property damage, business interruption, equipment damage, and the use of raw materials. And what we started, we deep dived into each of those components, and we found that health and safety team had their own records, so they were able to give us the data. We actually looked at water usage, electricity usage, raw material usage, and we found a lot of discrepancies there. We were actually able to see that there were spikes when electricity dropped, which that means the plant was not operational during that state. So we found a lot of proxies to be able to use that and quantify the risk profile. And what it turned out, when we did quantify the risk profile, it was actually the risk exposure was so much greater than the 3 incidents that they had in the incident report. So we clearly were right in the right direction not to use that. The team is still kind of expanding this methodology to all the plants because the company, it's a multi-billion-dollar corporation. It has many, many plants all over the world. But we've backtested it on 2 of the plants, and the results looked very reasonable. So that seemed like a reasonable approach. But more interestingly, even for the 2 plants that we've done it, we actually used this methodology to illustrate to the insurance companies that this is how we approached operational risk, and this is how we used it to adjust the maintenance budgets and give them more certainty that our maintenance budgets were better connected to the risk profile. Saved 23% on the insurance renewal. And by the way, let me paraphrase that. Increased the limits from $200 million to $1 billion, still saved 23% on the insurance. Yeah? So 5 times the limit, so the price should have went 5 times, but we still saved 23%. So that, by the way, is enough to pay for your whole team for the next 5 years. Just that single methodology. The next thing we did was a compliance team approached us, said, shareholder hates heat maps. We need something better for prioritizing compliance risks. Can you come up with some sort of quantitatively looking methodology that would allow us to prioritize compliance risks? So we did the simplest thing possible because we knew that that's one of the fundamental things in risk management. You have to very quickly decide whether it's a serious or a play pretend. Because there are many instances in life where you do a risk assessment, but it's not really going to change anything. It's not really meaningful. It's just play pretend. Like risk workshops. The first 5 minutes in the risk workshop, you have to figure out, are they going to talk about actual risks? Like you usually come with all the risks on your cheat sheet. And are they going to talk about the real risks, or is it going to be play pretend and we're just going to sing songs together and draw on the flip chart? By the way, every workshop that recently I've been in, they were all play pretend. So I don't really go to risk workshops anymore. I don't feel that they're a tool for risk management. So compliance approached us, and it was pretty clear that it was play pretend. So we had to give them a methodology that was reasonable, but we didn't also want to overburden them with the real risk. And I'll actually show you how we've applied the methodology to 30 risks, and they were happy. The board was just ecstatic. But then we deep dived into one of the risks on that 30, and it actually turned out that the real risk exposure when we deep dived into it was like 30 times greater. So, there's a big difference between play pretend and real risk management. And you can't do real risk management until you deep dive into a specific risk. Again, in my experience, you could be different. But I'll talk about the kind of advanced a little bit later. So play pretend, we came up with a bow tie By the way, there's a QR code where I kind of go into this methodology a little bit more. No, I think a Danish professor goes into that methodology a little bit more. So we came up with the most basic methodology, bow tie, which has 4 consequence scenarios, which is no consequence, minor fines, moderate fines plus some other government action, and 4th scenario, major fines, government action, and prosecution. And so any compliance risk kind of fits into that framework. It's really simple. And then we just, we collected a lot of data from all the different government sources and the experts within and outside the company, and we were able to allocate ranges to each of those scenarios, because legislation usually kind of gives you what the fine range is. It gives you, for example, for environmental legislation says that the regulator can close your plant for up to 90 days. So you know exactly how much that's worth. You can multiply the revenue of a single day by 90, and that gives you the range from 0 to 90. And by the way, it's never 90 days, because we actually collected the statistics, and on average it's about 5 days. And by the way, even that scenario where the regulator actually closes your plant because of the environmental damage, minor environmental damage, is also quite unlikely. So we collected as much data as possible, but we used experts for everything else, because remember, that was play pretend, and everybody understood that was play pretend. And so we had a bow tie, and we put a Monte-Carlo on top of it, because we had a kind of probability of each of the scenarios, or the weight of the scenario, and we had a range on each of the consequences. And we actually got a heat map. The compliance team asked us for a heat map, so we did a heat map that looks like it's supposed to look like a heat map should look, which is a log normal of the average exposure versus the log normal of the VAR. It gives this kind of pretty picture. We showed it in the board presentation, slightly kind of fancier with like risk names and everything. But it's what it did. It just prioritized all the risks by importance, and it gave the board kind of comfort that somebody is looking after compliance risks. Again, keep in mind, because this was play pretend, we actually deep dived. Like a week later, we deep dived into one of the risks from this methodology. By complete coincidence, somebody else approached us and said, like, oh, we want to deep dive into this risk, another team. And we did deep dive, and it actually turned out the methodology did not hold, did not pass the back test, because our recalculation showed that the risk exposure was much, much greater than we originally anticipated. And that really gave me one of many warning bells, because the methodology sounded pretty decent. We had 4 scenarios. We collected as much data as possible from the regulators, from the databases, from internal experts. We spoke to them. The internal experts validated the whole thing. So we actually spent quite a lot of effort on this play pretend methodology, only to discover that it was way off. And that's one of the reasons why you have to be very careful with high-level kind of top-down methodologies, because there's really no way you can understand the true nature of a particular risk if you're trying to apply kind of simplistic, generic methodology across the board. Or at least this is what happened for me. I was never able to really pinpoint a risk if I just used the generic methodology. That's why kind of I deep dive into a specific risk. And here's the final kind of basic case study. This was actually a business plan, a strategic business plan, like a 5-year strategic business plan that had to go to the Ministry of Finance for approval. And this was an amazing story, because when the management team prepared their strategic business plan, and they were kind of discussing and preparing the presentation for the Ministry of Finance, part of the exercise that the risk team does is that they run kind of a stress scenario. They run a stress simulation on the business plan, challenge some of the assumptions, and here is the list of the assumptions that we challenge. They're saying foreign exchange is going to be this, and we're saying, well, what if it doesn't? And they're saying, we're going to exit these projects and we're going to enter this project, and we're saying, well, what if you don't? And so on. Like every meaningful assumption that they make, we usually just kind of, we shake it. We shake it and say, well, what if it doesn't happen as quickly as you want or as successfully as you want? And in the first version of the model that we've done, it actually turned out that there was an 80% probability that the whole business plan would collapse if they went ahead with this version of the business plan to the Ministry of Finance. And so the management actually ended up completely changing, rewriting some of the assumptions and some of the priorities, and changing the whole kind of, not changing the whole investment strategy, but making significant adjustments that the final version of the business plan that went to the Ministry of Finance had a probability of success 70% and 30% probability of risk. And this was amazing on two aspects. One, this presentation for the Ministry of Finance was very meaningful because we were actually trying to obtain $1 billion in extra government funding. So this was kind of a major milestone. We had to show that the business plan was stable and sustainable to secure additional funding. And the second point, which was a big thing for me, nobody has ever in the country at the time communicated to the government that there is a chance of failure. Like it wasn't part of the culture to say that, yes, 30%, and it was a sovereign fund specializing on high-tech innovation. So super high risk. Very surprising if they somehow showed that they had no risk. Like, I mean, that is just straight out lie. But there was no culture to show that there's risk involved in using government money. And the fact that the CEO showed to Ministry of Finance the version which said there's a 30% probability of failure and liquidity issues, and you will need to give extra government, rescue. This was pretty gutsy, I felt. So this was a very interesting case. We basically we then resimulated, and this is kind of what the final version looks like. These are just cash flows for each of the years, and you can see that there are mainly positive scenarios and some negative, but then kind of towards the year 6, things begin to get pretty scary. Kind of giving a hint that maybe additional government funding will be required. And by the way, we did backtest this model many years later, and actually turned out to be pretty accurate. So wrapping up on the basic case studies, it's better than qualitative risk analysis, but it still has huge limitations because this top-down look at risk, it doesn't give you any insight and doesn't give you any information into control effectiveness or mitigations. Like, these methodologies are not designed for mitigation conversations. Mitigation conversations can happen when we deep dive, and I'll show you some examples of that. And remember how I said expected losses, unexpected losses, and the tail? Tail is where all the catastrophic risks lie. And these methodologies, again, are designed to completely exclude catastrophic risks from the analysis. And that's why they're called basic. So it's very important to keep that in mind. And that's what the reason why they're called basic is that because they're used primarily for reporting, information, monitoring, sometimes for high-level budgeting and maybe limit setting in the organization. So these methodologies have very limited scope of application. For everything else, there is the next slide. So it would be naive to try and use things like a risk register for mitigation, or it would be naive to try and use a risk profile, even if you quantify the risk profile for mitigation. You need something completely different for that. And so for advanced, I have a few case studies to share. The first one was water pollution, which is one of these compliance risks that turned out to be 15 times greater than we originally anticipated. And when we started deep diving into the water pollution risk, it actually turns out, well, first, the good news is that there's a lot of legislation around that. And the legislation is pretty explicit for what the risk profile should look like. And we've built a bow tie or a decision tree for that risk. And that risk actually has, it's probably difficult, maybe it's not that difficult to see. It had like 5 or 6 branches of consequences. There is the kind of administrative fine, there's the cleanup cost, there's the prosecution, there's the closing of your mine risk, and there are some other payments that were all part of the kind of prescribed consequences. So when we started, basically all we've done is, remember, this is the risk where we had 4 scenarios, high-level scenarios. And now we took the same risk and we deep dived into it, and it actually turns out there's not 4 scenarios, but there are like 6 consequences. But then within each 6 consequences, there are formulas for calculating the actual fines. You know, some administrative fine is easy. It's like anywhere between, 0 and $1 million. That's easy. But for most other payments, there's actually a formula that depends on the actual chemical compound. And because there are like 100 chemicals that pollute the water, each one has a concentration, each one has a prescribed concentration. And so we actually build a calculator for our environmental team, which has all the chemicals, and they plug in their test results, and they plug in the government authorized limits, and then the model calculates what the risk exposure is. And then because the risk exposure would be different for every single plant, and every single plant has a different pipe, there are usually like 2 or 3 pipes that pollute. So there would be, like, we build a calculator for each of the pipes within each of the plants, and we've done it for the biggest plants, so it wasn't that big. And each of the plants had different concentrations, different authorized limits, and there are kind of additional complications in the legislation. If you've got a special storage facility versus so anyway, there was, the it was time-consuming to discover, but it was pretty rewarding, and the legislation is pretty explicit about all of those things, and the environmental team specialists, they know all of this stuff. So it's few conversations, and we built a calculator. It was a pretty kind of funky, simple calculator at the end. And what the team did is they started plugging in all those chemical concentrations and putting in the numbers, what's the kind of day revenue for a particular plant. And so we've put all of that in, and discovered that the actual water pollution, this environmental risk exposure for that specific plant was like 15 times greater than we originally anticipated. But B, most importantly, the reason why environmental team and the production team approached us is that they had a lot of difficulty justifying a water purification plant, because it's like, I can't remember, like $20 million something. And they had trouble building a business case for that. Well, we showed them that the risk exposure was 200 million that we were sitting on every day until we built the water purification. So that really helped them build the business case, and they actually got approval. They were struggling with approval for like 2 years. We helped them build the business case, and they got approval pretty quickly. But the most important, the most fascinating thing was when they started plugging into the calculator the parameters of the water purification plant, it actually turned out that the water purification plant didn't reduce the exposure sufficiently enough. It reduced it from like 200 million to 100 million, still too much. And so they actually ended up implementing additional controls like evaporation pools that the water need to go through before it goes to the purification, something or other. So anyway, they actually ended up changing their mitigation strategy because the risk exposure was still too big based on their original mitigation strategy. So I thought that was pretty cool. And yes, I do have a workshop at the Risk Awareness Week where I talk a little bit about that. The next case study is what we used for insurance. And so for insurance, just keep this in mind. In a single year, the team reduced. Actually, no, let me start with the important bit. In a single year, our team has doubled or tripled the limits on most of our insurance policies. Because once we started calculating what our actual risk exposure is, and all we did was we asked insurance companies, how do you price risk? What sort of models do you use to quantify the risk exposure that you insure? And to our, I think, joint embarrassment, it turned out that the insurance companies on some of the corporate lines use pretty basic models. I was kind of disappointed because I started with a fancy model and I thought I'm going to impress them, but it actually turns out they use kindergarten models. And so we scaled back to kindergarten models as well. And we started calculating what our risk exposure is for every single renewal. As I was given responsibility for insurance, and it wasn't big because our shareholder wasn't really a fan of insurance. So we had, I can't remember what our portfolio insurance was, like 30 million for a multi-billion-dollar corporation. Not a lot, because he was only insuring what he was supposed to insure, and he was kind of retaining, knowingly and purposefully retaining a lot of other risks that he didn't have to insure. So our portfolio was like, I don't know, 30 million, and the first discovery was we were underinsured across the board. We were, like, for example, our chemical plant, we went with the engineers, conducted risk surveys, not how the brokers do it, but we wrote our own scope, we conducted our own with like independent risk engineers, conducted our own surveys, mapped all the worst case scenarios. It turned out like our original insurance was like 200 million for property damage and business interruption. Our new limit was like $1 billion. So we were significantly underinsured across the board. And same on cargo, same on like most on liabilities is probably less. And the first discovery was we were underinsured. So we doubled and tripled and sometimes quadrupled our limits. And normally you would expect what happens to the premium when you double or triple your limit. It goes up, right? So this is the fun exercise. Because we already had those models and we knew, but part of the product is, you know, how much risk you have, but also it's a very easy calculation how much this risk is actually worth, because we already know how insurance companies think. And so we actually calculated the fair price of our insurance policies, and we've done that for most policies. And surprise, surprise, it turns out we were overpaying for insurance. But not just overpaying a little bit, which is fair game, but we were overpaying a lot. And so keep in mind, we doubled and tripled limits, we didn't really touch deductibles, and we improved wording in every possible way. So we still use like all the biggest brokers, and they brought in their best practice wording. So the policy, like no additional limitations have been added. In fact, we widened the cover whenever it was possible. Still saved 40%. Saved 13 million in a single year. I mean, if that's not a success story, I don't know what is. So we tripled our insurance, still saved millions of dollars. That just pays for the whole risk team. Like whenever I needed like risk management software, I just got it, because I don't really have to justify things. I already made a lot of money, and this is actually kind of the module that Archer is hopefully will release in the near future. Is basically the kind of the engine, the calculation engine behind the same methodology that we use. We did exactly the same. We created a calculator where you just plug in your loss data, your claims data, and if you can obtain some claims data from the industry, that kind of makes it better, but you don't really have to. And you plug in your claims data, and it automatically calculates what's the fair price of your risk profile. It gives you the risk profile, and this is what we've done, and it kind of generates the submission report. I don't know if any of you are involved in insurance. Submission reports are usually like, I don't know, 3-5 pages that brokers prepare. Well, we forbade them from doing any of that or speaking to the markets without us. And we started doing our own submissions, which is like 50 pages. And it's a very compelling business case which literally starts, this is how much this risk is worth. And this is like 50 pages of evidence why this risk is worth this much and not more. Give us the best price. And we've done it every single time in Latin America, North America, Europe, Asia, and we were in the process of doing it in Africa as well. So this works every time. The only exception was D&O, because D&O is just absolute joke. Like there's no economic logic behind the pricing of D&O. It's just, I think it's an embarrassment to the insurance profession. So this was kind of a very fascinating case study, and I felt pretty good coming to the end of year review to the audit committee and saying, well, this is how much we saved through better quantitative risk management, and they just kind of paid for everyone's salaries. in my team at least. The next case study, and I only have 2 more case studies to go. The other case study is something that is, I think, sexy at the moment: third-party risk management, procurement. This is the next area that we deep dived into. And I hope you can kind of see that sometimes we did the top-down, but then we just basically started focusing on we deep dived into insurance, and we spent a month on one insurance renewal. Then we deep dived into procurement, and we spent a few months deep diving into procurement. This is actually a conversation I had with the CEO and the board. I said, it's your choice. I can do high-level everything, or I can deep dive into one big risk at the time, and maybe have 2 risks on my plate at the same time. And you'll have generic coverage of everything, or I can make a lot of millions in one risk at the time. And they both said second option, because the risk is owned by the business anyway, and just because I'm not there, it doesn't mean the risk is not managed. It's just the responsibility of the risk owner, which it always is anyway. So technically, the risk manager doesn't have to be there. The person responsible, Treasury is managing their market and credit risk. Sales is managing their credit risk. And so our approach was deep dive, and really deep dive into a particular problem and work on it until we solved it, until we made a lot of money, and then kind of move on to the next problem. So I had maybe 3 or 4 risks in a year that I would deep dive, and every time we would make a lot of money. So this one was procurement. And with procurement, we broke it into 3 components. Again, has nothing to do with the third-party risk management that you usually hear at the conferences. I don't understand why. But this is how we've done it, very different. We broke it into 3 stages. First is pre-qualification and accreditation, and there's some sort of preliminary risk analysis that needs to happen there, so we don't accredit. And again, keep in mind, this is a $20 billion company, so they have thousands and thousands of vendors, construction, everywhere in the world. So they need some sort of automatic process for pre-qualifying them. People can't review that. And so just like many companies in the market, they bought the software that promoted and offered 155 risk factors that automatically recalculates your accreditation and gives you daily updates, and it monitors for sanctions, monitors for compliance issues, monitors for bankruptcies. All of those things are really positive. So the risk team was invited, and by the way, one of the challenges in implementing what I would call this advanced risk approach is being invited or being kind of allowed to test your practices. So with procurement, that was actually surprisingly easy, because we looked at their KPIs, and the KPIs were save money on procurement. And so we came back to them saying, well, that's a pretty dangerous KPI, because saving money is not difficult. You just buy cheaper things. What this does, it automatically increases your operational exposure, because you get delays, counterfacts, and breakdowns. And so by buying cheaper, you don't necessarily improve on the overall. You just shift the risk to the operational departments. And so we offered a risk-adjusted metric to her, saying that, why don't you map your KPIs against the budget and the risk exposure? And you should be rewarded for reducing the risk exposure as well, because sometimes buying more expensive actually makes more business sense than buying cheaper. So anyway, she was super excited that we could kind of get her out of that hole where she was a very smart lady. She knew that buying cheaper is not, and constantly kind of driving for the reduction in cost is not sustainable. And so she allowed us to investigate. And the first thing we've done, which was I thought was absolutely fascinating, we looked at this. The company already purchased the market leader in this accreditation, validation, this kind of sanction checking, tax checking software. I'm sure many organizations are using them. So they had a model which said we have 155 factors, risk factors, we monitor, it's all external data, it's all automatic, it's like state of the art. So we backtested it, and this is why backtesting is so important. We backtested the model. We knew what were the bad suppliers, we knew what were the good suppliers, and we just kind of ran through those samples through the model to see what happens. Which was hilarious because the first conversation I usually have with a software provider is like, send me your backtests. And most of the companies have never even heard what backtests are. But many have. So, yeah, some companies are better than others. And so we asked them for a backtest. They said, oh, we don't know what that is. So we've done our own. And it actually turned out that if we followed their out-of-the-box setup, because they had all these weights allocated and all the priorities for different factors, and all of these factors were kind of switched on, and we used to monitor. So what we discovered is that if we actually used their model out of the box, then it would give us like an error of 70%. That means a lot of bad suppliers will go through, and a lot of good suppliers will be blocked. And that was just horrible. Like that would just can you imagine how many millions that would cost if we just completely blocked a lot of good suppliers and allowed bad suppliers to go through? So we then started investigating, and this is when my mathematician team got a little bit fancy. They started using artificial intelligence, neural networks to investigate, well, given that we have these 155 risk factors, which are the more meaningful ones? And it actually turned out that out of 155, I think only 30 were meaningful. The rest were just a waste of space. So we completely switched them off. We didn't switch them off. We gave them a weight of like 1, so they don't matter. And it was interesting because there was so much hype in the advertisement. We've tested the model. Actually, turns out to be a flop because they did well on sanctions risk, they did well on bankruptcy risks, and that's it. Like they couldn't pick up on anything else. No operational performance, safety, credit, liquidity. Like they couldn't pick up on most other most other important risks. So we stayed with the provider, but we just limited their scope to kind of this very narrow application of checking for sanctions, checking for bankruptcies. Probably could have used a much simpler software for just those two things. But anyway, it turns out that when you backtest somebody else's models, it doesn't always come as advertised. And this was the first application of the third-party risk management. The second application of third-party risk management was, well, okay, once we accredit somebody, we now have to figure out, well, what's their performance and credit risk. Credit risk, to determine how much advances we can pay, we need to set up some sort of limit on how much advance we can pay to a company, just like sales do in their normal credit limits in sales. We had like a separate mathematical model for calculating what is the appropriate limit for a vendor. And we created a model, which we borrowed from some Italian guys. We created a model for performance risk. So we actually identified a number of factors, including the previous relationship, the speed of delivery, the complaints, and some other factors that allowed us to prioritize the vendors based on on their performance risk exposure. And so we used this the same industry, ABC, and we were able to allocate all of these thousands of suppliers into buckets based on their risk exposure. And then the final idea that is not yet implemented was risk-adjusted pricing. The idea is that when you receive 2 quotes or 2 tenders, especially if it's like for high tech, it's usually millions of dollars, they're not apples-to-apples comparison. So somebody says, I will make it cheaper, but I will bring you unassembled equipment, and then you have to store it and you have to assemble it. So that obviously comes with a lot of risk compared to somebody who brings in the equipment and already assembled and has his own storage facilities. So the risks are not equal. And so the idea was to come up with a methodology that risk adjusts the price or create some sort of other metric so it's risk-adjusted apple-to-apple comparison. Haven't done that yet, and as far as I understand, I have not seen a company that did that yet. So stay tuned for that. The first two parts have now been implemented. Yep. Hmm? Yep. It's part of that second piece, which is basically when I say performance risk, it's our kind of fancy name for saying that this contractor delivers on time, on quality, and the product performs as intended. So one of the underlying reasons for that is their own supply chain. So that would be one of the factors in that kind of model that we use for allocating them to the buckets. A is the kind of the lower risk, and D is kind of the worst. And the final case study, which is, I think it's like 15 years old. This was my turning point, after which I've never used the heat map again. I was the head of risk of a sovereign fund, and one of the investments was it was like multi-billion-dollar investment into solar generation. And in fact, it was the national solar generation company. And it was the company that was supposed to create the industry for solar generation. That was many, many years ago. And for years, we had a heat map for that project, and it was all red. And it had mitigations, the company had mitigations, the management was kind of working on it, and it was all red. And by some, I don't know, miracle, but I guess really just the investment team foresight, at some stage they came to us and said, can we pilot the quantitative risk analysis based on that project, which we all know high risk, but we just want to understand just how high risk. And so this was the first time where we applied, again, this was like 15 years ago. This was the first time when we applied quantitative risk analysis to a company and tried to calculate like what's the fair value of that company, what are the chances that this company will pay back the loan to the sovereign fund, what are the chances that this company will survive. And this was fascinating because the top graph, I mean, you can't really see the details, but it's not really important. What you can see is a straight line. Normally, it's a distribution, which basically means what are the chances of company paying back its loan? And usually it's like the chances are from like 0% to 100%. There's some sort of distribution. And you can see like what's the expected chance? Is it low, is it high? This was the first time ever where we run 10,000 simulations and the answer was always the same, 0. There was 0 chance that this company would ever pay back its loan. And in fact, when we calculate the second, when we calculated the liquidity, it actually turns out that the company, to survive, needed an additional like $500 million investment tomorrow. And we then went ahead and kind of did all sorts of other calculations, and we determined that the company would go bankrupt in like 6 months. And the next calculation was even more interesting. We said, well, what if the team implemented everything they had in their risk register? What if they implemented all the mitigations? And the models showed that the company would go bankrupt in 8 months. So there's literally nothing that the team could do to save the company. This was fascinating because I did the memo. We did like, I don't know, it took us like a week to do the analysis. I did the memo to the CEO. The following day, I see a newspaper article saying the CEO just met with the Deputy Minister for Energy to talk about the solar energy generation legislation. Because basically what the premise of the story was, the costs were very volatile, and depending on a lot of macro assumptions, the tariffs for solar generation were structured in a way in the legislation that didn't allow any volatility. They were basically set in stone. And when your cost base started to become very volatile because of the macro environment, your kind of revenue side stayed fixed. Basically, the company just exploded. And within 6 months, the legislation for the solar generation was changed. And this is now the biggest solar generation company in the country. So this was fascinating because we had the heat map for months, and if we'd done the risk analysis, we could have done exactly the same, years in advance. We've had the heat map. It was always red. Everybody talks about it. Every 6 months, we did the review. We've done all the usual rounds. and nobody just realized just how horrible the situation was. It just doesn't give you the kind of the specificity of what is the risk and why is the risk and how does it, like when it will explode. And just one risk analysis was enough to change the legislation in the country, national legislation. So I'm particularly proud of that case. All right, some key takeaways to summarize, and then ask me all the questions you want. In my experience, it's much more useful to conduct risk analysis in the context of a specific decision or a specific budget or a specific business plan. ISO says, risks are to the objectives, but in my experience, it's so silly to conduct risk assessment for the purposes of understanding how it relates to an objective. It has to be something a little bit more concrete than just an objective, because the objective is just too high level, too generic. Some specific, very down-to-earth, pragmatic decision. This is what Taleb calls f of x, function of x. There's a big difference between understanding what your risk is and understanding how that risk affects cash flow or P&L or balance sheet or something. So f of x is the function of x. How does risk or many risks affect something? That's why I'm not a big fan of like people trying to quantify cyber risk for the sake of quantifying cyber risk. I would have, if I ever had to, which by the way I try to avoid as much as possible, I specifically said I'm not going to take you on as one of my deep dives into the risks this year. I would much rather calculate how cyber risks affects your business plan cash flow for the next year than just to calculate the kind of the loss curve for cyber. And same for any other risk. It's much more powerful to have f of x. For example, like when you do an investment project, you calculate how risks affect NPV and IRR, as opposed to just saying this risk is worth, on average, 50 million, but it could be, it has a VAR of like 100 million. That's not particularly useful. But saying that the cash flow can be reduced by something is much more powerful. So risk side distribution in my world, and it has expected losses, unexpected losses, and the tail, and the risks are not independent. In fact, I'll show you a link to the little guide I did on risk registers. I did just a fun exercise. I took a generic risk register, any risk register on the planet. You can do the same exercise with yours. And I tried to kind of calculate what's the risk exposure in a typical risk register and what would have been the risk exposure if the math was correct in the risk register. And the difference is 17 times. The actual risk exposure is 17 times greater than what you probably think it is in your risk registers. And I have that for free, so you can replicate that. And risks are not independent. That's one of the breaking points. We think that every entry in the risk register is a standalone thing. It's not. The combined risk exposure is so much greater. Like it's scary how much greater it is. So my experience proved to me once, like again and again and again, that if we want to start talking about mitigation, we want to make a difference to a particular risk, we have to deep dive into that risk, like really, really deep dive. You can't deep dive by having a conversation about the frequency and impact. That's not deep enough. You have to kind of really break it down into what are the different consequence scenarios, what are the kind of the specific, almost like chemical components of a consequence scenario for a particular risk. Most risks on the planet, I still believe that. Like I'm yet to find a single risk that does not have an existing methodology. And I can bet that any risk on the planet can be fixed with either an influence diagram, a decision tree, or a bow tie with a Monte-Carlo sitting on top of it. Any risk on the planet. And that's why I made a joke on LinkedIn, and people got really upset. I said I can quantify any risk on the planet in 15 seconds. it's kind of a joke, but it's also kind of true. I can. It's just the range will be very wide. That's the thing. You know, people say, oh, we don't have enough information. Well, that's the whole idea of quantifying risk. You have a bigger range. As you get information, you reduce your range. You never reduce it to full certainty. You always stay at some uncertainty. But that's the whole idea of risk management, is you always start with with a very wide uncertainty, and then you just reduce it possible. There's the whole theory on that as well, by the way, which probably most people are not familiar with. It's called value of information. You can actually mathematically calculate how much money you need to pay to get more information for it to be economically viable for you to reduce uncertainty. You don't even have to guess whether you should do this additional, should you delay this investment project by a month to find more information? All of that is calculatable. It's not a guessing game. So some risk assessments, on the other hand, have proven time and time again to add additional error and basically be no better than horoscopes. So they are outright dangerous. And people, anyway, I'll let you ask that question. I'll answer it when it comes. Yeah, risk management 1 is the thing that I just call having the risk appetite statements and risk reports and risk frameworks and everything that ISO 31000 kind of expects, which is not really true. ISO kind of wants to do the right thing, but COSO, yeah, let's say COSO. Everything that is kind of COSO style, I call that risk management 1 because it's governance. It's a facade. You should probably have it, but you really shouldn't spend too much time on it because it only serves a single purpose. If the auditor asks you to have it, you say, yes, I have it. Although, again, it's kind of entirely up to you because I always felt the need to speak to the auditor when they, every single year they would send me a document, standard document request, and some junior manager would send it. And I'm saying, get me a call with a partner. I'm obviously not talking to the manager because I'm not wasting my time. And every year we would have a call with a partner, and every year I would show what we've done, the models that we use, and they would never ask for a heat map again until next year. And then next year it would come again, and then I would have the same conversation. And I would have the same conversation with rating agents. But I like having those conversations. It's this sadistic fun in me having those conversations. So not everybody's cup of tea. So most organizations, if somebody expects you to have risk management 1, just do it. And just keep it simple. You don't, to update a risk register, you don't have to waste executives' times to sit down and update the risk register. You can update the risk register yourself. And especially with ChatGPT, they can update the risk register for you. And I'm not kidding. Any risk management 1 document, risk appetite statement, policy, framework, can be written by ChatGPT in 15 seconds. I'm not exaggerating. Which is kind of the scary thing because ChatGPT has been trained on risk management 1. So if you ask ChatGPT about risk management, you're guaranteed to be given a wrong response. It's all risk management 1. Unless you explicitly ask about risk management 2, somebody did it, sent me screenshots, it knows. It knows about my theory. So anyway, some resources to look at. Risk Awareness Week, every year, 50 workshops from some of the best risk managers that I personally learn from and respect. Most of them are free. And YouTube channel, blog, and I'm not exaggerating, there's an answer to any question you can think of in the risk space. Because I've been doing this for a very, very long time. And here's something that I've published just last month. I started doing guides, very quick guides, and I highly recommend Guide on the Risk Register, because it's really fun. I'm literally just showing step-by-step calculations on how your true risk exposure for the same risk register is actually 17 times greater than what you think it is. And I have a guide on risk appetite. That's an exciting topic. Here's a hint. No risk appetite statement required, ever. And you still keep the regulators happy. All right, final 2 jokes. There's this famous mathematician, he says that the whole the whole exact science, the whole world is based on the idea of approximation. And this is what risk management is all about. We're trying to approximate future. There are multiple futures. We're trying to approximate them. And the narrower range we can create, the better. But it will always be a range because the future is always uncertain. And the final joke, there's this cognitive bias called Bader-Meinhof phenomenon. And it's basically once you see something, once you learn something new about quantitative risk, now that you know that quantitative risk makes a lot of money for your companies, and no one questions whether we need risk management. Nobody questions whether does risk management add value? Like nobody ever said that to me, because it's so blindly obvious when you start applying quantitative risk management. I never had to build complex business cases for why I needed additional resource, why I needed to hire a quant, or why the last quant I hired was a WhatsApp to the CFO. I said, I need a quant. He said, okay. The same with insurance. We had a couple of WhatsApps because I wanted to hire the most expensive insurance guy in the market. And the same with software. And when you start kind of making a lot of money, it's just, everything in life becomes just so much easier. So anyway, this cognitive bias is once you hear something, you will now start seeing opportunities for quantitative risk management in your life and in your work. So hopefully these few case studies that I shared were helpful to you. All right, questions? Yes. Sure.
So first of all, thank you so much for your presentation and a ton of insights across your adventures in risk management. Question to you, how did it feel clicking send on that email to the CFO telling him his whole company was losing?
It was, so this was a very, it's a fascinating story. It's more fascinating than you can imagine. It was at the board, it was at the executive meeting, and they all kind of speak in terms and they presented the business case, and they're like, oh, this is the business case, and the CFO is saying, we're just kind of passing above the liquidity line. We're going to stay cash flow positive. And then the CEO turns to the risk and say, well, what risk do you have to add something? And I'm saying, well, we've run the simulations, and it looks like we actually have a 99% probability of cash deficits. And in fact, our cash deficits could be humongous. And like there's a 90% confidence interval that our losses would be up to, I can't remember, like 80 million or something. And it was fun because the CFO didn't like it. He, by the way, lost his job soon after. And it was fascinating because with risk messages, if somebody's on the board feels the same way, they will jump on it on the train immediately. And I was just lucky at the time because a couple of executives felt uneasy as well. And when I said this business plan does not fly, they said, I told you so, and jumped on board and kind of hijacked the conversation. It could have easily went the other way around. They could have destroyed my methodology. I could have been fired on the spot. But somehow I was kind of lucky in that way because I try to be kind of polite, respectful, and I choose my words very carefully when I'm presenting to executives. And I'm speaking in probabilistic terms, so I'm usually deep diving very much into the analysis. So all of my assumptions, and by the way, this is one of the big difference between qualitative risk analysis and quantitative risk analysis. Whenever I present quantitative risk analysis, I have 2 pages of limitations. Like I have exclusions, limitations, all my assumptions are transparent. I literally have a table that shows these are all the assumptions that we modeled, these are the ranges, these are the sources of information. I put a lot of effort into not being destroyed by somebody who just doesn't feel like listening to me. And so that kind of went surprisingly well, because I think it just gave them the nudge. They knew they would have to go to the government for extra funding, and it just gave them the kind of the mathematical justification for that. And in fact, I spent a week in the Ministry of Finance showing them our methodology, and we've actually done a workshop in our office for the Ministry of Finance and Ministry of Economics employees explaining how risk management methodology works. So they appreciated that our analysis was solid. And it actually it turned out to be true and timely. Yep.
How do we go about, whether you're in a consulting firm which is advising clients, or you, that senior risk manager or chief risk officer, sitting in a business where the board of directors are, in most businesses, I say, I'm going to say this the right way, are not innovative. They're herd. So they want to be part of the pack rather than not being outliers. What you're obviously doing is very much on the outlier side. So how do we start sparking that conversation, have that first conversation and say, let's talk maths and let's get answers.
Yeah. For some reason, it never was like, you make it sound like it's a difficult thing, but for some reason it never was. It was always kind of quite natural, because the thing with risk management too, and the rollout and the implementation risk management too, is taking it one step at a time. And you can pick whatever, like for example, I usually start with investment projects. They're easy. Investment projects are quantitative by default. Yeah? You already have NPV, you already have IRR. The only thing you add into that conversation, you're saying, well, what is the probability that the management's forecast is actually going to be true? So you're saying, you stress test the model, and you're saying, well, what's the probability of success for that specific project? That's not a very difficult kind of added point to the conversation. In fact, what I usually do is I don't create my own narratives as a separate conversation. I just kind of replace some of the narratives that the investment team is doing anyway, and whenever they talk about the risks, I give them the information to list there. Whenever they talk about the sensitivities, I give them the information to say. So I'm trying to replace some of the quantitative practices that exist within the organization by just better kind of risk math. So that's an easy starting point, investment projects. Insurance is a very easy starting point, because who doesn't like making better insurance decisions and saving money along the way? Insurance is quantitative by definition. You've got the premiums, you've got the limits, you've got the claims data. All of that is quantitative. That's a very easy entry into the quantitative conversation, and it could be anything else that is kind of relevant in your organization. In mining, in oil and gas, there is usually already risk analysis in the exploration, in the deposit forecasting. The good starting point is finding people within the organization that are good quants already. And by the way, everybody in your treasury and corporate finance know quantitative risk management better than probably me. So it's not difficult finding people that are good quants within the organization, and finding them, and then kind of finding common ground. What can you add or change in their approach so you make it risk adjusted? So treasury is an easy place to start. Investment is an easy place to start. Strategy team on new projects, if they've got some sort of strategic projects, that's an easy place to start. Insurance is just a really easy place to start. And then it kind of just goes from there. It's basically finding a person who is friendly, quantitatively inclined. He doesn't have to be a math genius, just quantitatively inclined, and doing some sort of pilot with that person. And it worked for me every single time. And I always found people within different departments that it's like, oh yeah, I did Monte-Carlo at uni, or yeah, we've tried this on a business initiative a few years ago. And even my CFO, like he always said like, oh yeah, distributions. He usually would add like a swear word on top of it, but yeah. So yeah, I would start with friends whose willing to try something new. So that's a very good question. I wrote an article a few years back, what are kind of the 5 competencies that the risk team overall should have. And it was decision science, understanding the science behind, because you think that decision making is intuitive and everybody's doing it in a different way. Like there's the whole Stanford and Harvard degree on how to make decisions. There are professors, there are textbooks, like they've done this many, many years ago. So decision science 1, probability theory, which is the math. The second one, neuroscience, which is the human side. Because, for example, there's 2 Nobel Prizes in economics that explain why you have very close to 0 chance of getting honest answers in your risk workshops. In fact, the chances are so low that risk workshops are pretty much a waste of time. And unless it's a play pretend, and then you just draw pictures and everybody's happy. And so there's a lot of science around that. Again, 2 Nobel Prizes in economics, in making decisions under uncertainty. And so neuroscience is a big one. Then, of course, understanding the legislation and the standards, knowing ISO 31000 still helps. Although, let me quickly make an analogy about ISO 31000 so there's no confusion. You know how when you go to a doctor's surgery and there's like a brochure at the reception? Well, that's what ISO 31000 is, right? You don't become a doctor by reading a brochure at the reception of the surgery. You become a doctor by learning about anatomy, chemistry, and biology. And so this is what, in risk management, it's the same. Biology, chemistry, and anatomy is decision science, probability theory, and neuroscience. And ISO 31000 is like a nice summary of some of the ideas. In a weird way, because I was the representative of the TC 262 a few years ago, and it was a little bit weird environment. We had 60 people in the room working on the ISO standard. Out of 60 people, 5 were risk managers. The rest were just like academics, consultants, government officials, and very vocal, clueless about risk, but very vocal. So it was a weird thing. So, don't use ISO 31000 as your guide into learning risk management. Go to the books that I shared because they are the underlying science. And it's people that write ISO, they borrow from the underlying science. Go to the source. Don't go to the condensed summary brochure to learn about risk management. So coming back to question 4 is understanding the standards and the legislations, because in many industries there are prescribed methodologies for how to deal with risks. And the final one is understanding the nature of the business, understanding how the business works. And so these are the 5 competencies. And the 2 quants that I hired were just mathematicians. I did take a shortcut. I have 2 WhatsApp groups. One with most risk managers in the country, and it has 300 people. And the other one with the quants in the country, and it has 10 people. And back in the day, we did a national conference just for quant risk management. And we made it sound very technical, just to scare everybody away and really pull out the quants that are real quants. And so we recorded all the names. And then out of these names, I went around and talked to everybody, and I found 10 who were hardcore quants. And then I added them to my little pool that I kept for the future. And I literally took them out for dinner, and I paid for the whole, I spent a lot of money trying to cultivate this little group of quants. Because later, I hired 3 of them. One was later headhunted into a different company, but I hired from that chart. And they were risk managers that were quants by design, were never able to apply quantitative risk analysis to the extent that they wanted in the previous company. So they Again, it was such an easy conversation. It was, for how much money would you join me? What's up? He sent me a number. I'm sending in a number to the CFO going like, can I hire him? He goes, okay. And like I'm saying, pack your bags. It was very, very quick and easy, which is, I think was lucky. All right, any questions? Yes, please. Sorry, can you repeat the last part? How did I arrive at the figure? I got that. I'll say.
How do you express it as a single point, not a distribution?
Yeah. Okay. So 13 million savings, which is how much our current year premiums were lower than the previous year premiums or comparables. And this is the summary for executive purposes. This was actually 5.7 million on constructional risk, 3 million on cargo insurance, 1.6 million on property damage and business interruption, 500,000 on something else, 1 million on something else. So this was just a summary of all the different savings that we got from every policy renewal that we've done.
Just insurance, not by actually avoiding risk in the first place. That would be actually.
What do you mean?
Well, the risk doesn't happen. You haven't even looked at the insurance, and you actually avoid the risk in the first place.
Yes, but if the insurance is required by either contractual obligations or by law, you have to purchase it regardless. And the fact that we purchased it for 40% less, that's where the savings come from. In that conversation, it doesn't matter if the risk happens or doesn't happen, because last year we had the same insurances. We actually doubled the limits or tripled the limits, so we've improved on last year's coverage. So we don't care whether the risks, for that conversation, we don't care whether the risks happen or not happen. We already made a lot of money for the shareholder. Sure, but that wasn't our objective. Our objective was to take what the company had and make it better. We did a million other things to talk about the risk that you mentioned.